Do you feel like every day you look at the news and you hear something about the economy? Journalists talk about jobs, unemployment, and the markets. But what is the stock market, and how do stocks work? We're buying low and selling high in this episode of FactBites. The global economy is complicated. Far more complicated than what can be explained in a 10-minute YouTube video. Instead, this video is going to explain the basics of what stocks are and how they work. First, a disclaimer. We are not providing financial advice. Investing money in stocks is not guaranteed and may lose value. We are not advocating any specific stock, company, brokerage firm, investment firm, none of that. As always, consult an expert. Millions of Americans own stock and may not even know it. If you have a retirement account at work, there's a good chance you own stocks. Some people like to buy and sell stocks on their own. You can do this through a broker or online through a trading site like Schwab, E-Trade, or one of the many other investment sites. If you do your homework, the stock market can be a great way to make some money, but it can also be a great way to lose money. Think of it as a casino. But the game you're playing is betting on a company making money, which in turn you hope will make you money. First, what are stocks? Stocks are shares or pieces of a company. It's an investment. You hand over some money, you own a tiny percentage of that company. These are referred to as shares. Why do companies sell stock? Selling shares is one way a company can raise money, and often raise large sums of money. When a company starts selling shares of itself to the public, it becomes a public company. There are many implications about what this means, but one of the biggest things that comes with a company going public is transparency. Public companies must disclose quarterly and annual financial statements. Basically, they have to tell investors, the people who are owning their stock, how the company is doing. As stockholders, you get to vote on the company's board of directors and have some, albeit minor, say in how the company is run. Your vote is essentially equal to the number of shares or the percentage of the company that you own. So if you only own a couple hundred shares of a big company, your vote is pretty small. When a company goes public, they issue what's called an initial public offering, or IPO. In 2019, Uber, the ride-sharing company, issued its IPO. They set an initial stock price of $45 per share. The stock hit the market and Uber made $8.1 billion. That's a billion with a B, almost overnight. Unfortunately, an investment in Uber hasn't paid off for investors yet. As of the writing of this script in February 2020, Uber is now trading around $32 a share. That means if you bought one share of Uber at its IPO in 2019 for $45, you would have lost $13. Companies issue IPOs because stock is a great way to raise money to fund future growth and expand the company. Say you own a fast food restaurant in the Midwest. Customers love your food and you open up a second location, a third, a fourth, a fifth. Things are going well. You have multiple locations and you'd like to expand. Opening a new location is expensive, and while each of your restaurants is making money, you may not have the cash in your bank account to fund the opening of more locations. You have a few options. You can take out a loan, but that can be expensive and difficult to get a bank to approve your funding. You can also seek out private investors. But if your company has good financials and you think you have broad appeal, you can explore an IPO. The influx of money from investors would allow you to expand quickly. Now, I will point out, this is a very simplified example. Your little localized fast food chain is probably not going to have an IPO. Stock shares are normally a tiny portion of the company you're investing in. For example, companies will issue millions of stock shares, and their shares may only represent a portion of the company. Companies can determine how much of the company they want to sell to investors. For example, your restaurant wants to sell 30% of the company. At the IPO, you value your company at $50 million. 30% of that is $15 million. You want to set your IPO at $5 a share. That means you'll have 3 million shares to sell to investors. So what's in it for you as an investor? You're giving a company your hard-earned money. What do you get in return? Well, the return is the key word. Your goal is to buy stock, watch it go up in value, and then sell that stock at a higher price than what you bought it for. The difference between what you paid for the stock and what you sell it for is your profit. For example, let's say you bought 10 shares of Company A for $20 a share. That's a $200 investment. The company has a good year and the stock has gained $5 per share. Your shares are now worth $25 for a total value of $250. If you sell your stock at $25 a share, you made $50 on your investment. That $50 is your return on investment. It represents a growth in your money by 25%, which is pretty good. If you go back to the 1970s and 1980s when interest rates were high, you could put money in a savings account and banks would pay you interest in the 5 to 10% range. Right now, in 2020, interest rates are low, sometimes less than 1%. That means keeping your money sitting in a savings account doesn't really make you any money. You could argue you're losing money because of inflation, but that's another video. However, the stock market in general continues to go up. The historical rate of return for the market is about 10%, meaning that if you invest today, even if the market goes up and down, in 10 years you should have gained on average 10% per year. Some years you'll make more, some years you may lose money, but in general you'll average 10%. Stocks are traded in exchanges. These are collections of companies. For example, in the United States, we have the New York Stock Exchange and the NASDAQ. Exchanges shouldn't be confused with stock indexes. Financial news outlets often report numbers for the Dow. The Dow, which is short for Dow Jones Industrial Average, is actually just an index of 30 large companies. It's an average that shows you how those companies are doing, not the stock market as a whole. The Dow is made up of big companies such as Walmart, Disney, Microsoft, and Visa. The general theory is that if these big companies are doing well, it's a sign of how the market is doing. The S&P 500 is also an index, similar to the Dow, but it's made up of the 500 largest companies. Generally, the S&P is a good indication of where the market is going, up or down. When buying stock, there is various financial data that you can look at to make an educated decision on whether to buy a company's shares. Companies must report earnings, which is how much money they made or lost. This is done on a quarterly basis, which is every 3 months. A company will generally report total revenue, the profit margin, and earnings per share. If the company is losing money, the earnings per share will be a negative number. Many financial news sites will also tell you the stock's 52-week high and low number. This is the highest the stock has traded for over the past 52 weeks and the lowest price the stock has traded for. You can look and see if the stock is trending higher or lower. Is the stock predicted to keep going up, or is it on a downward slide? Analysts will look at financial data and make predictions. As a stock buyer, you can look at this research and make a decision based on the financials. If selecting individual stocks sounds stressful and challenging, it can be. This is why many investors select mutual funds. Mutual funds are collections of stocks. Many investment firms sell target funds. These are funds with a target date in mind to earn you the highest rate of return by a certain date, which is often when you plan to retire. A fund manager will review the fund regularly and change which stocks make up the fund based on the fund's objectives. Funds will have a prospectus, which is a report that shows you the makeup of the fund and the investment risk. High risk can mean high return. Low risk usually means lower returns. This is where long-term versus short-term investing comes into play. Long-term investing is when you buy a stock or fund and plan to hold on to it for years, possibly decades. Short-term investing is when you buy and sell more quickly. Short-term investing can lead to bigger returns, but it requires you to buy and sell at the right time, which can be difficult to predict. Here are a few things to keep in mind with buying stocks. In the United States, if you make money on stocks, you have to pay taxes on your profits. These earnings are referred to as capital gains. Uncle Sam always wants his share. Next, research before buying. Look at the global markets as a whole. Buy what you know. If you like a certain company or are familiar with their business, that could be a good investment. Never invest more than you can afford to lose. We hope you have a better understanding of how stocks work. Remember, this is a simplified overview of the stock market. Always seek professional advice before investing. What did you think of this video? Leave us a comment below. And if you have an idea for a future FactBites episode, let us know. Don't forget to hit subscribe and click the bell icon to be alerted whenever a new episode is released. Thanks for watching.